Take real estate as a shot or as a fully stocked cooler. This is the 5 o'clock Somewhere Real Estate Investor Podcast. We're bringing common sense back to real estate investment. So crack open your beverage of choice, sit back and relax, and allow us to learn you a thing or two.
It is 5 o'clock Somewhere. Jeff, you were going to bring the Johnny Walker. You forgot? Are you having problems with your mic again? We bought all our equipment at Goodwill, so I apologize for the
Dollar Tree.
No one even said, God, good job, Brett. The studio looks great.
Looks good.
I think it looks good.
Need a neon stamps. We need a neon stamps real estate sign, a neon light real estate sign.
It's 5 o'clock Somewhere. Real estate podcast, investor podcast is beginning right now. Jeff, you got anything else you want to say before we go? But I thank you for the applause on the great job in the studio. That glue is something else, man. I tell you, I walked out here like Snoop Dogg on Willie Nelson's bus when I was done. I was high as crap.
Shower curtains. Hey, the shower curtains do
it's
look
not shower
nice.
curtains, man. That is actual material. We just need to steam them. We just need to steam them.
We are sponsored by Title Assurance and Escrow, a title company here in Cordova that does all of our closings, title work, escrows, and we only use Title Assurance and Escrow. That relationship is very important because we can get things done for our investors quickly and easily. So to speak with Title Assurance and Escrow, call 901-737-3332. Ask for Chris or April.
All right, so let's get going with the podcast. Jo Garner is back with us. We had an amazing episode with Jo Garner. It ended up being a corrupted file, so we couldn't produce it. So we brought her back today so we can kind of try to reinvent, and I don't think we could reinvent perfection because that episode was, but we'll do our best.
Corrupted file. What happened? Tell them what really happened.
Oh, no, it's fine. We're going to re-record now. Jo is here, but it was such an amazing episode. So, Jo, welcome to the show.
Thank you.
Give everybody an idea who you are and your contact info and what you do for a living. I mean, you do a lot, but your main focus is...
Brett, thank you so much. I'm in the mortgage business. I eat breakfast, lunch, and dinner with mortgages, and I love investors because I'm an investor also. And I wrote a book called Choosing the Best Mortgage, The Quickest Way to the Life You Want, and it's for people who are buying a home to live in, but it's also for a whole section for investors. So, Brett, I love being a mortgage officer and an investor at the same time.
Excellent. I'm glad you were able to come back today. We're going to talk today a lot about a new in-house DSCR loan product that you have.
Oh, yes.
And we're going to talk about some of our properties that we have sold and the different types of properties and what the cash flow projections are from a mortgage person, somebody who's going to be writing your loan, what kind of cash flow you can expect. And then I'd even like to get your input on what a smart young investor should do with that extra cash flow.
Yes, and I believe you have that too, Brett.
Yeah,
you know
absolutely.
what to do about that.
I do, but from hearing it from me, apparently doesn't carry as much weight as it does somebody who's in the mortgage business who should be telling you how to do this the proper way.
Yes.
So let's get started. Tell us about the company you're with and the product, the DSCR product first.
You know, Brett, the most exciting thing that's happened in this industry over the last couple of years has been the DSCR mortgage product. It stands for Debt Service Coverage Ratio, and what that means is that it's a business loan that's secured on residential investment real estate. So the better price you're going to get is if you have lease income coming in and your principal, interest, taxes, and insurance payment is the same or better, or less rather, than what you're getting for lease. In other words, you're making a positive cash flow. You don't have to make a positive cash flow, but your rate and your terms are so much better if you are making a positive cash flow. They're not going to ask you to bring a wheelbarrow in full of your tax returns and leases and all of that. Your income is verified simply on the lease or potential lease income on that subject property that you're purchasing or refinancing.
And what's counted as an expense against that income for the purpose of the DSCR loan?
It's principal and interest, taxes, and insurance.
Okay.
Now, if you have an association fee with that property, that monthly figure would also calculate into that as well.
So out of your profitability, you're dealing with mainly management if you're going to use a property manager. So let's go through a property let's take one of these properties and let's say Jo Garner, the wizard of DSCR, writes the loan. What can we expect this investor to do? What would they make?
Okay, so most of the investors that we're working with right now, they're still going to have to verify their funds to close. Usually on a purchase, it's about 20% down. On a cash-out refinance, usually around 75% down. There are some exceptions to
25% down?
I'm sorry, 25%
So if
down.
I had 75% down, I just wouldn't even refinance it.
Right.
Just pay cash.
75% loan to value, 25% down. Yes, Brett. But that's what to expect on money down, information you need to use to qualify. We pull credit, tri-merge credit report. The property has to be in good condition when we're doing this permanent DSCR
Rentable
loan.
Condition, correct?
Yes, it has to be in rentable.
So DSCR will not work for a rehab project.
It will not.
Okay.
We have another way of doing those, but today we're talking about DSCR, and it has to be in pretty good condition, good title on it, a quick turnaround, less than 30 days, and it's for purchase and refinance.
Excellent. All right. Well, let's talk about a particular property. Let's give an example. Now, we talked on a previous podcast about the type of properties here and gave some examples of what the properties were like, how they worked from start to finish, but we didn't really get too much into the cash flow. So let's talk about that.
Yeah. You've got a couple of examples that you sent to me, and they were very exciting. One of them you call turnkey.
Right.
And
turnkey basically for me is we have builders that are buying an older home, need some work, and they're rehabbing it top to bottom, inside and out, putting a tenant in place, and then selling that property.
Right. Now,
with a 1-year builder warranty, I might add.
This one is just an example. It can vary greatly depending on the credit profile and what the property taxes are, insurance on a particular property. So that's my disclaimer, and this is for educational purposes. I went and did a scenario as if they had high credit scores. They were putting 20% down on a 30-year fixed rate loan with the 3-year prepayment penalty. And I was using one of your listings on Bitter Creek in Memphis just as an example. On that one, Brett, I got real excited about it because, the market rent you have here is about $1,550 or so a month, and the price of around $153,000. Looks like, based on my calculation, the positive cash flow on that would be somewhere between $500 and $600 a month. That's
right.
Very exciting.
So you take that $500 and $600 a month. Let's do that times a year. Let's get your gross. Let's do a quick calculation here. We did this on your radio show.
Yes, we did.
So let's take $550 times 12 months. That's going to give us a gross of $6,600. And let's say we put 20% down.
20% down. This is a purchase.
So
yes.
20% down would be around $30,000.
Your total move-in with your down payment, closing costs, prepaid property taxes, and insurance would be somewhere between $30,000 and $40,000.
Jeff, quiz. Based on her numbers, how much does the investor have out of pocket invested in this property?
Well, at the end of the year, you just subtract the $6,000 from the $30,000 down payment.
Well, hold on. So that's right. You've got $30,000, maybe $35,000 out of your own pocket invested in this property. A lot of investors get sideways with this, but the balance of that money, that purchase, where did it come from? It came from a bank. It's not out of your pocket. You borrowed it from a bank.
Yes.
And the tenant's paying rent, allowing that rent to go back and pay the bank back. So you really have no money out of pocket other than that $30,000 to $35,000.
Yeah, your initial investment always, but we're going to talk about ways to get that back pretty quick,
so let's take the $6,600 a year and divide it into $35,000, which is the cash you now have out of pocket. That's an 18.8% return on your investment. Cash out of pocket investment.
Yeah.
Right?
Yep.
And then when you look at it that way, and I try so hard to get these investors to realize your loan is not your money. It's the bank's money. And the payments that you're making is not money out of your pocket. It's the tenant's money. So what do you truly have invested in this property? And when that light bulb goes off in an investor's head, then their whole dynamic on how to invest in real estate changes. And they really begin to look at the cost of a mortgage versus the rent that's coming in versus the expenses of maintaining that property become big factors. So, I mean, that's fantastic. All right, let's go on to a different property.
You have another model that it's new construction. Now,
which I love.
Yeah, I do too. My mother used to say, look, Joe, if you're going to invest in something that's brand new, because then at least there's not a big chance you're going to have to be doing repairs for the next few years. So a new construction, that has a whole different element of a positive advantage there. This one you gave me was on Rose Creek. You were selling it for $185,000.
New construction.
Market rent, you said, was around $1,895 a month. And, you know, somewhere with a rate in the low to mid sevens in that range or so, it looks like your positive cash flow on that, very exciting, between $800 and $900 a month.
All right. Well, let's be conservative. Let's say $750.
Okay.
All right. So you got $750 times 12 months. It's $9,000. And how much cash out of pocket does this investor have invested?
Between $40,000 and $50,000.
Must be on the high end and say $50,000.
Okay.
18% return on your cash out of cash investment.
Wow.
18% return.
Right.
You're never going to touch that in the stock market, your 401k, anywhere.
Not even your Bitcoin.
Oh, come on now. No, don't pick on my Bitcoin, man. My XRP is when my XRP takes off, screw you. I'm out of here. You can come down to the Caribbean on my 100-foot yacht and visit if you feel like it. But until that day, I'm going to sit here and put up with you. Well, no, not even on your Bitcoin. I mean, I'm sure there are people that bought Bitcoin 10, 15 years ago that are very wealthy today because of it. Let's face it, that's not reality. That doesn't happen to everybody. If you really want to be wealthy in life, you work hard, you plan, you stay diligent, you stay disciplined, and you make it happen. We talk about this a lot on the podcast, and that is, how do you become a millionaire in single-family rentals? And you and I talked about this on the radio show.
It's a long game.
It's a long game, and that is, you buy a property, you invest $35,000, you get an 18% return on your money, but do you take that 18% and go buy a new car or go, take your wife on vacation? No, you take that money and you put 50% of it in the oh crap fund for if something goes wrong, right?
Right.
Now, that's not your money. Where did it come from? It came from the tenant.
Yes.
So you put part of that tenant's money aside. You take the rest of it, pay it down toward your principal, and pay that asset off as fast as possible. So that $185,000 house in 10 years is worth $240,000. It's paid for, and now it's producing $2,200 a month in clear cash flow.
That's an exciting thing. Why I personally like to be in real estate investing, because where are you going to find an asset that, first of all, you can get in with very little percentage of the value of that property? It's called leverage. You put 20% down, you've got a property that's worth a whole lot more than what you've got in it. And that property over time, and there are some exceptions as we talked about, Brett, but over time, real estate has gone up in value, not down. But
if it does go down, what's it always going to do?
It's going to come back up. And the monthly income on it going up. So you have you have an asset that's going up in value. You have income on it that's going up in value. From the mortgage desk, I want to tell you the 30-year mortgage is a huge advantage. In the United States of America, we're the only country that offers a true 30-year fixed rate loan. And why do I love them? Because if you have a 30-year fixed rate loan, that principal and interest is fixed forever. It's never going to change. And every time that tenant pays you more and more rent each month, you're giving yourself a raise. When you raise the rent, you've just given yourself a raise. So your income's going up, the value's going up, and you're making money. That's what it's about.
Right. And that's the key. That's why you invest, right?
Right.
The trick.
Hey, Jeff. I didn't know you were here.
The trick for me is that you teach these young investors to do just what you said. Everything goes into reserve. Everything pays that mortgage off. Double, triple down on it if you have to. Get that first property paid. I mean, I don't care if you've got 2 properties, 10 properties, 20 properties. Get that first property paid for. Okay? Liquidate it. Your little starter property is $120,000. You got 5 down payments on 5 more rental properties.
That's right.
There's a way to do this with an initial $25,000 to $30,000 investment, and you will never have
or
to
leverage
spend
it.
Yeah, you'll
Leverage it.
You start out with one down payment, and there's a way to do this with not ever having to put another down payment down on
That's
another house
right.
again as long as you live.
Now, let's what is the long game, Joe? And we've talked about this. The long game is for a 25, 28-year-old, has a career, he's married, just first baby born, and he's thinking about his future. Your goal needs to be, over the next 25 years, is to buy 20, 25 properties.
Mm-hmm.
And that when you turn 50, and you're still a good number of years away from retirement, now all of a sudden you've got 20 properties paid for that are now worth $4 million
Mm-hmm.
and are now producing $40,000 a month in gross income.
You don't really need a job at that
That's right.
point. You can do what you want.
That is the angle of what you should be shooting for when you invest in real estate. Now, we deal with seminar issues a lot here. I mean, we've had to go to counseling to be able to say the word seminar. For me, it's been a 4-letter word. And they preach to you that you need to go out and buy as many properties as you can, and you're going to make $1,000 a house. Well, you buy 10 properties, that's $10,000 a month. You quit your job and you go have fun and be Donald Trump. We all know in the real world that's not going to happen.
Right.
Because
Well,
you have costs, you have expenses, you have things that go wrong.
The other problem with that is these places teach you how to go out, down on Florida Street and pick up 10 properties for $20,000 a piece, do a half-ass renovation on them, put a tenant in it for $400 a month that's never going to pay the rent.
Nope.
And it's going to absolutely destroy what little bit of work you've done to the house within 30 days. That's what these seminars are teaching you to do.
Yeah, and they're misguiding, unfortunately, a lot of investors. And the only reason why I can say that with 100% certainty is because they call us.
Right.
You have to treat your real estate investments like you would any other investment. Your stock portfolio, your 401k. You don't withdraw your mortgage payment or your car payment out of your
your
retirement
dividends away
account.
from your stock account. You just have your broker reinvest it for you. Reinvest
So
it.
you've got to teach
Why
yourself.
are you reinvesting?
Yeah, you just have to teach yourself to do the same thing in real estate.
That's right.
But
You're investing for the future in your stock account and your 401k account.
you got to get in the mentality you have zero cash flow because you're pouring it all back into your investment.
I asked Joe on her radio show. I said, Joe, if I gave you $1,000 a month to put in your stock account every single month, no questions asked, would that be okay with you? And you're like, absolutely.
Oh, yes.
Well,
Any
that's all
day.
a tenant is doing. A tenant is sending you a rent check, paying your expenses, and putting money in your pocket. It's not coming out of your pocket. They're
Right.
putting money into your retirement account every single month.
Right.
And that's, if you view your portfolio that way, I promise you, by the time you're 50, God, I hope I'm not still here by then. That's a long time from now. But you can call me and say, hey, it worked. Thank you. I appreciate that.
Well,
but you'll be a very wealthy individual, and the rest of your friends will still be working, trying to retire.
When I first got into this business, I used to overthink it a little bit, but Glenn Green said it best. Glenn Green said that it's the easiest thing in the world. You buy the house, you put a tenant in it, and you let that tenant pay for the mortgage, the repairs, the maintenance, the taxes, the insurance, and you all the while are collecting all the equity in the house and benefiting from it. And he looked at me and he says, it's pure genius, Jeff. That's how easy it is.
Yes.
I think one of the great things so far is we've talked about the margin you can make on these properties. The bitter one, you're going to make a cash flow of $600 a month. We've not once mentioned rates because the rates don't matter. This is the cash flow we're going to get.
Before you go there, she gave a couple of very good examples of two properties that were cash flowing between $600 and $800 a month. I know we've talked in this podcast before, some of our little starter homes, 120, 125. These properties are producing, $200 or $300 a month. And then we always reiterate, it's not about
It's
the cash
economy
flow.
of scale,
it's about
right?
Right.
So is there something, Joe, is there something different that you're doing that's are your rates lower, or is there something you're doing to produce more cash flow on these two properties than the average person would?
Yeah, it is. And the products that we're able to use right now are helping us come in at a lower rate and lower number of points that you would pay. So that helps your return on investment. Of course, these vary according to your credit score and how many properties you own and how experienced you are. This can vary. I mean, the more risk involved in the person that we're lending to, the higher rate and points they're going to pay, because lenders are out to make money too, so it is
Really?
all about risk.
I didn't know that.
But look, it's a great partnership if we're offering you terms that can help you make a positive cash flow on a property with a reasonable amount of money out of your pocket. And if you're getting return on investment, and you can do the math, if that is, and you can consult with your financial advisor and do the math, it can work for you. And that's what's so exciting about today in this type of loan we're talking about, which is called DSCR. There are a lot of different types of DSCR products. There's myriad of different loan products in general. But today, the most exciting one, I believe, Brett, is this DSCR, low documentation on the income. You don't have to bring in your tax returns, pay stubs, or anything like that. It's a business loan secured on a residential income property.
Based on the income it produces.
Based on the income it produces.
So if I purchase one of Brett's new construction homes for $165, I know I can get an appraisal for $170, and I tell him I want to make an offer $167.5, builder to buy down a point and a half or something. That's just all the better, right?
Right.
Yeah.
Now, there's different guidelines with these DSCR loans because they're funded not by the government but by various private investors. So some of your DSCR loans have restrictions you need to pay attention to, like they'll only let the seller contribute a concession or paying closing costs up to 2% of the sales price.
Right.
Yeah,
Some of them don't
We
have
learned
that.
the hard way with
But-
Frank out in California.
Here's an advantage, and we've done this many times. Not all the products limit you. Some of them do have
Right.
limits of 2%. Some of them don't.
Some of them don't.
But I've done a number of deals recently where my investors that were buying 3 or 4 properties at one time from one builder would say, okay, I'm going to give them $170,000 a house, but I want a $5,000 credit at closing. Well, that makes sense for this investor. Why? Because instead of coming up with $100,000 cash for closing, he's coming up now with 65 because he's getting like Jeff Sloan bought 9. That would have cost him, I don't know, well over $100,000. But he got 9 times 5, $45,000 back from the builder at closing, which then he didn't have to come out of pocket with that extra $45,000. So it saved him money.
Right.
So there's all kind of creative ways. And if you can limit, you're out of the scenario we just talked about is fantastic with the 18% return. But if you can limit $10,000 out of your pocket and have the seller kick that back to you, and so you don't come out of pocket, you went from 18 to 20% right off the bat.
Right.
So there's all kind of creative ways to make that work. And obviously you need to call Jo Garner and obviously find out if that product will allow you to do something like that.
Well, thank you.
Yeah.
I'd love to do these numbers.
Give everybody
for people.
your number so they know how to reach out to you.
It's
and your website.
very easy to call. Text me 901-482-0354, or you can go to jogarner.com.
Perfect. Yeah, I enjoyed doing your radio show. We had a good time. A little different podcast, a little different than live radio. We were on a tight schedule.
Well, I'll tell you another reason, Brett, while I'm excited about investing in real estate. Now, everybody has their own opinion about which direction real estate is going. I pay money to hear regularly from people who are a whole lot smarter than me when it comes to seeing into the economic future for real estate. They've proven themselves over the years. Nobody has a crystal ball. I certainly do not. But if you look at the demographic model coming up over the next 10 years, it's exciting. If I were in I'd be buying every piece of real estate I could. Let's look at this model. It's the generation. If you look at the millennials, that's age 28 to 43 years old. There's 73 million of them, and 45% of them at this point own real estate.
How many?
45%.
45%.
By the time they were 30, 33% of them owned homes. By the time these early millennials were 40, 55% of them owned real estate. Okay, so we've still got some millennials coming up. Let's look at Generation Z. That's the age group coming right after millennials. Age 12 to 27. Remember, we're looking at a 10-year forecast here. There's 69 million of them. 8% of them already own homes.
Wow.
And this is age
Before
12
the age
to
of 30.
27, before the age of 30. Now, if the later Gen Zs come in and start buying at the age of 30 at the same rate the millennials have. We've got a lot of first-time home buyers coming in here, very healthy market there. By the time they're 40, if they buy at the same rate as their predecessors, the millennials, we've got a huge market. We've still got the late millennials that haven't even hit
purchase yet
30 yet or 40, and they're going to be buying homes. So if you look at that model, there's another one too. I don't really have it in here, but right now we're building about 1.3 million homes a year, but we're growing at 1.9 million households. So what does that do for our market? Our real estate, we're going to still be in a situation where the supply is going to be limited of homes, especially affordable homes, and the demand is going to be growing at a significant amount.
Mm-hmm.
So what does that do to the price of homes? It pushes the price higher. And if I'm buying something, I want it to go higher, Brett. I want that value to go higher. I want that rental to go higher, supply and demand.
Which and like we talked, it always goes up. Jeff and I have had this conversation before. When my dad bought our house I grew up in, I think he paid, $30,000 for it. It's worth $250,000 a day on the market. And of course that was 30 years ago or longer than that. I'm not going to say how long, but it was a long time ago. So typically over history, property values go. So let's say you buy a house today and 20 years from now, using the fact that there's going to be more buyers than inventory, which is going to drive up prices.
Mm-hmm.
Jeff, what would you say a $100,000 house today would be worth in 20 years? $200,000?
Oh, at least.
So you spend your time buying 20 properties at $100,000 a pop, they're going to be worth $200,000 in 20 years, and now you've got them paid for. Where's your asset wealth now? You are literally a millionaire, multi-millionaire. And you've done nothing but allowed a tenant to pay into your asset.
It's a beautiful thing.
They're doing all the work for you.
That's right.
90% of your millionaires are made so by buying real estate.
Now, 20 years ago, that model was, everybody knew that model. Everybody used that model. Everybody wanted to do that. But somehow in the last 10, 12, after 2008, you got all these clowns out of California and different areas who came up with all these harebrained schemes to sell ideas to people on how to invest in real estate. And now we've gotten these really weird and distorted views on how to invest in real estate and how to make it work and how to become a millionaire in real estate. And I hope that we get back to the common sense part of that.
Right.
And God knows we preach it every week. We preach it to our investors. I've got investors been with me for 3 years that I just had a conversation with yesterday about this, saying, listen, you're still going about this the wrong way. You're looking at this through the wrong optics.
Mm-hmm.
And if you look at it this way, this is going to make more sense to you. And once I was done with him, it just finally clicked.
Right.
He realized, holy crap. So I've got 12 homes now. I need to buy 8 more, and I can be a multimillionaire in the next 15 to 20 years. Absolutely.
And Brett, it doesn't have to be a house.
Or you can wait for your Bitcoin to go to $1 million.
Well, there you go.
Your choice.
And there's that. And Bitcoin is going to be an item coming up, but there's so many of these generations Zs and the late millennials who have heavily invested in cryptocurrency.
Yeah.
And when they get ready to buy their first home, as we see is coming, what are they going to want to use for down payment? They're going to want to use crypto.
Well, if the government has their way and we end up with a strategic reserve of crypto and it becomes a secondary currency in America, then there will be a day where you just get on your exchange and wire, $300,000 of crypto to a bank and you're done.
Did she just say I missed the crypto boat as well?
Yeah.
But here's another.
We all did.
Brett, back to what you said earlier, you don't have to buy a turnkey every time to make money and to use these type of financing vehicles, the DSCR loans. If you found a house that was just a bargain deal and it needed a lot of rehab, you can use hard money.
Right.
And you've got connections. I have connections to people who will do a hard money. Now, they're not your mama. I mean, they're going to charge you a hefty interest rate and a lot of points, and they're going to want their money back pretty quick, like 6 months to a year. But look, you can use a hard money lender, put it all in one loan to buy and rehab. And there's a reason why I'm saying put it in one loan, not 2 separate loans for the purchase and the rehab. Put it in one loan. Get the rehab done. Call me. even before the rehab's done, so we can go ahead and get started on your permanent loan, because you're going to refinance that property if you're going to keep it. And we're going to pay off that high interest rate hard money lender. And now you're going to have that beautiful 30-year fixed rate loan. You're going to have a property you're going to keep. That way it's better positioned to make you money. But now you've picked up the bargain, you've done the repairs, and if you've spent the right amount of money on the purchase price and the repairs, you've got an asset that can make you money over time, and you can still use a DSCR loan just after it's repaired.
And, you know, back when we were kids, what was the American dream? What did they preach to you? Why do they preach to you to buy a home? Buy a home today while you're young.
Mm-hmm.
Pay your note every month for the next 30 years, and eventually the value is going to go up. And when you get ready to retire, you've got a $200,000 asset paid for, right? Same concept applies to rental properties. Same concept should apply, because when I was a kid, that's why my dad bought a house, because one day I'm going to retire and I'll have an asset paid for that I can leverage and retire off of.
Yes.
Or sell and take the money and move to Florida.
It was part of our parents' retirement plan.
Absolutely. That was the American dream.
You know, people weren't switching jobs and relocating other parts of the country every 3 to 5 years like they are now.
Right.
You went to work for Firestone or International Harvester. You stayed there for 30 years. You took your pension. You paid your house off. You died in it.
Well, my grandmother, when she married at 17, 18 years old. She lived in the same house from that day to the day she died.
Wow.
Same block. And you know where she grew up as a little girl? Half a block away. Like, she literally spent her entire life in a 1 block geographic area of Hammond, Louisiana.
That's the way it was. My entire dad's side of the family grew up off North Parkway in Memphis. All the aunts, uncles, everybody lived within a block or two across the street or down the street from each other.
Well,
their entire lives.
Every investor should take that American dream philosophy from the 70s and 80s and 60s, 70s and 80s and use that when you get into real estate investing. And if you use that model, that long-term vision, I promise you, you will wake up one day at 45 and realize you're a multimillionaire. And that if you don't want to go to work today and quit your job, you can now do that. You can say, I'm done, right? I'm going to retire. But if you go off this concept of cash flow, give me the money, let me spend it, you're going to be 70 years old going back to work after trying to retire because you won't have enough income or any assets to retire off of. That's a fault of our generation, I think. We kind of let the American dream slip away, and we stopped teaching our kids how to benefit from these types of programs, how to invest for your future. We raised a bunch of kids that we want it now. I need it now. I need it this instant. I can't wait till tomorrow. So that's why Amazon, you order it, and an hour later it shows up at your door, right? And that's a tragic part of our society today, but I hope we get back to that investment. And I'm sure going to preach it every day. Get back to the long game, and I promise you'll have a much brighter future. Well, Jo, I really appreciate you being here. Would you give everybody your contact information one more time? I'm Jo Garner. That's J-O, and you can connect with me at jogarner.com, 901-482-0354. Pick up my book, Choosing the Best Mortgage, The Quickest Way to the Life You Want, on Amazon and Barnes & Noble. I look forward to being on your mortgage journey. Thank you, Jo. I appreciate you being here.
Thank you, Jo.
You've been listening to this 5 o'clock Somewhere Real Estate Podcast, 901-692-7401 or mymemphisinvestmentproperties.com. Have a fantastic day or night or drink or whatever the hell you're going to do. See you.
For more common sense real estate tips, listen and subscribe at 5o'clocksomewherepodcast.com. The 5 o'clock Somewhere Real Estate Investor Podcast is a Sound Ideas Group production.